This is an Uncovered Japan Company research report on Plus Alpha Consulting, ticker 4071. It is a Japanese HR tech SaaS company whose talent palette platform helps large employers turn scattered people data into decisions. The investment question is whether an unusually profitable business, now trading at a 5-year low earnings multiple, can keep compounding as its market evolves. The headline numbers explain why Plus Alpha stands out. Revenue compounded at almost 30% over 5 years. Operating margin reached 37.3%, and return on equity was 24.3%. At 21.6 times forward earnings, the shares are at a 5-year low, and below the roughly 38 times sector average cited in the report. That is not a claim that the stock is cheap in every sense, but it sets up a clear gap between quality and valuation. Start with the product. Talent Palette is the core enterprise talent management system. It brings employee information, skills, and workforce data into one place so customers can make human capital decisions with more structure. The business is not trying to win a low-end price war. Its focus is larger customers, a higher ARPU position, and long-running data relationships. HR Solutions supplied 77.5% of fiscal 2025 revenue, making this the engine investors need to understand first. This revenue mix shows the concentration clearly. Talent Palette alone represents 71.5% of revenue. The smaller HR subsidiaries take the HR Solutions total to 77.5%, while the Marketing Solutions products, Miyaruka Engine and Customer Rings, account for the rest. The structure matters. The company has a dominant recurring HR platform and a second data-oriented business, but the marketing side is the area where execution has been less consistent. The 5-year operating record is unusually clean. Revenue grew from 6.1 billion yen in fiscal 2021 to 17.1 billion yen in fiscal 2025, a 29.3% compound annual rate. Operating profit grew even faster, at 31.9% annually. That combination is what makes Plus Alpha different from a typical early-stage SaaS story. Growth has come with operating leverage, rather than a widening cash burn. Net income needs context. Fiscal 2025 operating profit reached 6.38 billion yen, but net income was lower at 3.26 billion yen after a 1.15 billion yen goodwill impairment on acquisitions. The report treats that as a reason to anchor on operating profit and cash flow when judging the core business, while still recognizing that acquisition discipline and future impairment risk deserve attention. Cash flow supports the earnings picture. Fiscal 2025 operating cash flow reached 5.15 billion yen, and free cash flow was 4.99 billion yen, equal to a 29% free cash flow margin in the report. Alongside a roughly 79% equity ratio and no debt burden highlighted in the research, that gives management room to invest, return capital, or absorb periods when growth is less linear. The report's moat argument has 4 parts. First, Plus Alpha brings roughly 15 years of text mining know-how to its data products. Second, its enterprise focus supports a higher ARPU position. Third, both major segments earn around 45% margins at the segment level. Finally, founder leadership has helped create a consistent operating record, though it also creates a genuine key person risk. The moat is therefore built on workflow depth and execution, not merely on being an HR software vendor. Looking forward, management's midterm plan targets 30 billion yen of revenue by fiscal 2029, from 17.1 billion yen in fiscal 2025 and 19.5 billion yen in the fiscal 2026 estimate shown here. The report sees a credible path through deeper enterprise adoption of Talent Palette, but identifies 2 variables to watch closely: whether the marketing business revives and whether Plus Alpha can defend its data advantage as generative AI makes some analytics features easier to replicate. Valuation is the pivot. The report places the forward price-to-earnings ratio at 21.6 times, below its approximate 5-year average of 28 times, and well below the roughly 38 times sector average. The comparison supports a value score of 4 out of 5, but not a free pass. Price-to-book remains 7.6 times. The market is assigning a lower multiple, despite high profitability, likely because investors are weighing the marketing slowdown, founder dependence, and the AI question. The scenario work is a framework, not a prediction. At 3 years, the report's own bear, base, and bull cases are 2,550, 4,575, and 8,400 yen respectively, against a reference price of 2,650 yen. The base case implies about 73% upside, while the bear case is roughly 13% below the reference. The variables that move the range are not mysterious: sustained talent palette growth, recovery in marketing, and the degree to which AI becomes a threat or an enhancement. To sum up, Plus Alpha is a high-margin, debt-free HR tech SaaS company with a strong enterprise niche, substantial cash generation, and a valuation below its own recent history. The open questions are equally clear: the slower marketing business, dependence on its founder, and whether generative AI erodes or strengthens its data advantage. This is research, not investment advice. Use the full 5-part deep dive for the evidence behind each point, and keep those indicators on your watch list. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.